Hey, what's good, everybody, and welcome back to another episode of ETFs Explained. My name is Jordan from Make More Capital, and I am here to try and make the world a little bit more financially literate. So, I have covered VOO and QQQ so far. These are two ETFs that are on the New York Stock Exchange, and they track the performance of the NASDAQ 100 Composite Index. That's what QQQ does, and VOO tracks the S&P 500 Index. Now, I am Canadian, so I'm going to make this episode for the Canadians and just compare between two S&P 500 ETFs. So these are two exchange-traded funds that are on the Toronto Stock Exchange, so you can purchase them in Canadian dollars, but they track the S&P 500 index, which is in the United States, and it tracks the performance of the top 500 companies in the US. So before we go forward, though, there's one thing that you should know. If you are Canadian or if you're from any country outside of the United States, if you want to invest into the US without a registered retirement savings account, or with a RRSP in Canada it's called, or not even that, so forget I mentioned that for now. Basically, if you were to invest into the US from outside, you do have to pay what's called a foreign withholding tax, and you don't actually pay it, but it essentially gets taken from you out of your dividend payments. So this foreign withholding tax only applies to dividends, but it does apply to all equity funds. So that's mutual funds, exchange-traded funds, index funds, anything that has equity instruments in it, though. So if you are in Canada, the only way to get around this is to use an RRSP and then exchange your Canadian dollars into US dollars so that you can buy directly on the US market. If you don't use an RRSP and you use a TFSA or a cash account, you still pay the foreign withholding tax. Now, the thing is, it's only 15%, but, well, if you're Canadian, actually, I should let you know that because there's a treaty. If you are from outside of the US, or if you're from outside of North America, I believe, I don't know for Mexico, but I know that Canada pays 15% of the foreign withholding tax. In any other country, I believe you pay 30%. So that is the cost of investing in the US, but again, for the growth that you're going to see from these two investments, it's really worth it. Even if you're only getting 85% of your dividends paid out, still very much worth it for the growth. So the VFV is the S&P 500 Index ETF from Vanguard, and XUS is the iShares Core S&P 500 Index ETF from BlackRock. So these are two indexes, or these are two exchange-traded funds that do the same thing. They track the S&P 500 index. That is their benchmark. So a few things first. Let's look at the price. The price here is $72.43 a share for VFV, so that's how much it will cost you to buy one share. And for XUS, it is $50.28. So, of course, that means it is cheaper to buy shares of XUS. So if you had, let's say, $10,000 right now, you would be able to buy more shares of XUS, therefore be entitled to receive more dividends, because ultimately the goal of investing in a passive fund over time is to accumulate as many shares as you can so that you receive the passive income through dividends. So of course, the lower the share price, the more dividends you will receive, and that is one incentive to potentially choose XUS over VFV, but we're going to look at a lot more than that. So I'm going to just focus on this page for now, and then I'll try to jump back and compare, but the objective of the Vanguard S&P 500 ETF is to track the S&P 500. We know that. And the strategy is it copies the benchmark. It is passively managed, which makes it cost effective. And it is tracking basically the US market. So if you think that the US is going to just get bigger, grow, and the companies are just going to continue to grow as well, and the US is going to be the dominant player in the next 50 or even just 30, 40, 50, 60 years, then you would want to have your money in the US market. Now, the management expense ratio is 0.09, so it's extremely low. Basically, that is what gets taken off of your percentage off of the returns every single year out of the full amount invested. And some facts down here, basically, inception date was in 2012. The distribution yield for dividends is 1.65%. The dividends it does pay out dividends quarterly, and the income distribution per share is about 26 cents. And you are eligible to invest in this fund with the RRSP. Of course, though, there are a lot more benefits to using the TFSA if you're a young investor and you just don't know if you're going to hold that money until retirement yet. So that is the gist of, except for the returns, that is pretty much the gist of VFV. That's how quickly you can look at ETFs and just get an idea of what they have to offer. So if we look at XUS, it owns it's a diversified portfolio of 500 US large cap companies. It is low cost and it is designed to be a long-term holding. So if we scroll down, we'll check out this one's performance first. So with XUS, you can see that its average annual return since inception, which means since the day that this fund was created, is 15.82%. That's very impressive. So if you look at 1 year, basically looking at the current global situation that we've been going through, it has still performed at 3.72%, which is pretty good, despite everything that's happened this year. If you look at the last 3 years and divide it by 3, it's returned 9.17. The last 5 years divided by 5, it's returned 11.68%. So if you invested $10,000 the day that this fund was created, you would have over $26,000. So that has been a wonderfully performing ETF. And if we were to compare the performance of VFV, sorry, I want to click because I like to look at it from this point of view. If we were to look, oh, they always have it in such. Unfortunately, Vanguard's website looks like it's ancient. But basically, if we just want to look at the same metrics, it doesn't have the chart, but since inception, this one has returned 17.12%, which is pretty amazing. And so again, that's one of the other main factors you want to look out for is the average annual return. So 17.12% subtracted by 0.09, which would be 17.3%. That's what you can expect every year having your money invested in this fund since inception. Now, of course, past performance does not indicate future results, but if you try to remain logical and just think that, yes, the U.S. is going to continue to grow and likely be the influential power, this is the best place to have your money in. And so I'll quickly jump back over to iShares, and we saw their average, we saw their performance, but we have not seen their fees. So let's take a look at that. Their fees, their management expense ratio is 0.10%. So basically, if you look at the numbers, so 0.1, so it would be 15.72% that you're keeping after returns from this one. Again, amazing. This is where you want to have your money in. And although you may lose 15% of dividends if you're investing from Canada into the US, you're getting that growth though. That's what you want. You want those capital gains as well. So the last thing I would want to jump to and look at, or the last two things, would just be the portfolio data. So what is in this? Large cap, 78%. So this means that 78% of the portfolio is in large cap companies. 14% is in medium cap, and less than 1% is in small. And if we were to go down all the way, where is it, to the list, it will tell you the companies that are inside of it. So there are 507 companies inside of this ETF, and it goes down the ranks of names that you would want to have your money invested in. Microsoft, Apple, Amazon. And this tells you how many shares that this fund owns. So when you're investing your money and you're putting your money into 628,000 shares worth 139 million of Microsoft, and your money is being put into what owns that. And that's a safe thing, I think, and the transparency that you see with ETFs is speaks for itself. And if you look at the PE ratio, of course, closer to 10 means you're actually getting a better bang for your buck when you're purchasing shares, but 17.4 is not bad considering, again, everything that we've been through this year. So if we look at the holdings for this one, we'll jump quickly over. And what XUS actually owns is IVV, which is an iShares Core S&P ETF. So it's different than VFV, but XUS decides to own one of BlackRock's S&P 500 index ETFs plus, so 78% of this fund is invested in IVV, which is an existing ETF already. So this ETF invests in an entire ETF, 78% of it, but then it also invests in Microsoft, Apple. 1.24% is in Microsoft, 1.12% is in Apple. And again, you can go through here and see what all of the holdings are if you click all holdings and just browse through the pages. So the last thing I would want to check into, though, is the dividend. So I did end up taking a look. Well, we can jump back there. But so the portfolio characteristics. It seems that XUS pays out dividends semi-annually. So that means you will only receive dividends twice a year, every second quarter, semi-annually, twice a year. And the distribution yield is 2.45%. And the last share per distribution was 62 cents. So this means that the distribution yield, you will get 2.45% of this price, and it will be divided into 2 payments. And again, so the last one would have been 62 cents. So you can expect to get like 2.45% of the share price, and then divided by 2, and you will get your share of the profits for each semi-annual payment. And you can set up the drip, which is pretty convenient. So again, once you have enough shares, or once you own enough shares that it can buy another share itself, then it will do that every time you receive dividends. And if we jump back over to the price distributions here, again, it's definitely more old-fashioned, less user-friendly, this website, but you can see that it has paid, or these are the prices. Sorry, you scroll down here and you can see that it has its distribution history. And it pays out about 26%, or sorry, 26 cents for the payouts, 27, 29. But the thing is that we know about VFV is that it pays dividends quarterly. So you're actually getting 4 payments, but they are a little bit less than what XUS pays out, because 26 times 2 would be 52, or 54, sorry. No, it would be 52. And yeah, gosh, my math is bad. And so yeah, you would actually be getting a little bit more dividends with XUS. But then, of course, the fee is slightly higher with XUS, whereas it's a bit lower, although the share price is a bit higher with VFV. And lastly, we would just want to see, again, so you can tell if a fund is on the Toronto Stock Exchange if it's called XUS.TO, or if that's what you would type into your the ticker to search up this fund. This one, again, tracks the S&P. It holds 505 companies. Actually, number of underlying holdings. Oh, number of holdings is 506, so this would likely be the IVV. This one is not including IVV. This one is. Frequency is quarterly. It's equity, 100% stock inside of it. And this one was created in 2013. And the net assets is just the total amount of assets that the fund is invested in of all the companies. So that is the kind of walkthrough of XUS. And lastly, I will touch base on just like in the last day, it measures every single day. When the price opens and closes, it will tell you how much it has changed. And although actually VFV this year is, this one actually shows 4.49. So although this one's up 4.49, this year, year to date, not 1 year, but year to date is -3. So, or it's down 3%. So you would not have if you invested on January 1st, you would be down 3%. But again, this is not a normal year with what we've gone through. So I apologize. That was likely quite messy, but I am learning. I'm sorry about that. I hope you did like this video. If you got some value out of it, please like the video below and subscribe if you want to tune in for more ETFs explained going forward. So I will be bringing you the breakthrough and walk down of a new exchange traded fund every single week. So if you have the urge to learn how to manage your money yourself and, cut out these insanely high fees you get from active management, then tune into this channel and you will get tons of information, and you will be able then to make your own responsible and good long-term investment decisions, especially if you're someone that does not have the time to pick individual stocks, but you understand that compound interest is a way of life, and you just add a little bit every single month. So that is it for this video. Thank you so much, and please like and subscribe if you enjoyed it. We'll see you next week with a few more ETFs.